Hello and welcome. I am looking for some high quality companies to add to my investment portfolio. I want them to give me 10% a year plus return and have a low chance of failure. Now, I've come across an idea here. This is thanks to a viewer of the channel, Luke McCormick. So, thanks to Luke, he suggested look at Autotrader. So, I've looked at Autotrader, and here is my summary of the business. I've got 5 areas I'm going to cover. Usual 5 when I look at high quality companies. So let's get started. Firstly, the Autotrader, they've got a low debt to equity, around about 15-16%. That's low. And their ability to cover their interest payments, incredible. We're looking at something reach of over 100 times. So no issues on that front. Dividend that they have is affordable, payout ratio not far away from 30%. They're very much a sector leader, well known, certainly in the UK at least. Current ratio, the ability to pay the shorter term bills is very good. 1.6 or so at the moment, but it has been higher than that in the past. So my assessment of the chance of failure, the most important rule, rule 1, don't lose money, as Warren Buffett says. No concerns for me here at all. In my belief, although not financial advice to you, from my perspective, they're not like to fail, but I want to know that it's a high quality company. I think the most important measure for a company to determine its quality, as Terry Smith says, is return on capital. Long-term average for return on capital for Autotrader is roughly speaking 50%. 49% of the most recent figures. Anything above 30% is outstanding. The gross margins also very good, roughly 100%. So that's incredible. And if you go down the P&L, the operation is very profitable. Operating profit margins are consistently above 60%. Also incredible. Now, it's very good to make those profits, but can they convert them into cash or free cash flow, I suppose? And they do convert them well, over 100% conversion rate at the moment. They're very good at converting those profits into free cash flow, which is the owner's earnings. So for me, Autotrader is a very high quality company. I do look at other factors as well. I think the industry that they operate in is suitable. That's a good thing. And the dividend payout ratio, I look at to make sure that's affordable, appropriate for the company that they are. Now, they don't pay a massive dividend, which is great because they have a high return on capital. I wouldn't really want them to pay me a massive dividend unless they were running out of ideas, good ideas, how to invest their money. The dividends are around about 1.5%, payout ratio around about 30%. Could grow more in the future, but for now, I'm happy that it's at a lower level. They have done some share buybacks, although there was a little bit of share increase around COVID time. Generally, they've been talking about buybacks, and growth is predicted. So the company trajectory, at least by analysts, is expected to be positive. I'm looking at around about 7% a year growth, my calculation, and that's taken from looking at the analysts on Yahoo Finance and the analysts on Simply Wall Street. And here is the Simply Wall Street first of all. We're looking at future growth of getting towards 10%. It's a really good platform, by the way, if you're looking for good graphical analysis, visual analysis companies. And here we are on Yahoo Finance. You can see there at the bottom that is about 6%. I want to give a 7% to be reasonably conservative. So for me, the valuation, the most interesting part, because it's not so difficult to identify if a company's got a high chance of failure or is a high quality company, but it's buying it at the right price in order to make the return that you need for your portfolio and investment strategy. So I want really 10% a year. We've already established a growth rate at 7%. I've valued it via 2 methods. I've used a discounted cash flow method. So I look at the cash the business will produce, the free cash flow, discount it back 10%, and also 15% to today's pricings or today in time. So what's the value in today's money of all those future cash flows that the business will generate? I also look at an alternative method as well, which is adding the free cash flow yield to the growth rate. And between the two, we can work out what that expected return range is. So on the discounted cash flow, in order to get 10% a year, stock price needs to be £5.30. And to get 15% a year, looking at £4.40. Now, the market price is higher than both those figures. Market price at time of recording is £5.87, so the return that I would estimate from discounted cash flow is less than 10%. I estimate it, therefore, around about 7.3%. Free cash flow is 4.84%, and I wouldn't enter a position until I get to 5%. I'd add more at 6%, I'd add more at 7%. Quite close at 4.84%. It needs to come down to £5.68, and we're at £5.87, so not too far away. So the story really here on the valuation is that the estimated return at the current price is 7.3% to 11.8%. So 7.3% on the discounted cash flow at the current price, 11.8% free cash flow yield plus the growth rate. So it's a decent window, but it's not quite there for me. Let me know in the comments below if that's the sort of return you'd accept for Autotrader in order to buy into your portfolio. So the decision point for my portfolio is that it fits the strategy and structure of my portfolio as a high quality company with a low chance of failure. Would be a good use of a high cash position and is better than some of the companies in the portfolio. And the return is kind of in the required range because my minimum return, if you go back to my portfolio challenge, is 6.66% a year. But really, I want to be looking at 10 as the stretch target long term because that enables me to get to my target 10 years earlier. So the estimated return I had is between 7.3 and 11.8%. So it kind of straddles that area relatively nicely, but with no margin of safety. So I'm not going to buy it yet. I'm going to wait a little bit longer. It comes down slightly to around about the £5.50 range if it does. And then when it does, I'll add to the position. I'll probably make it a small position to start with. Then if it gets down to £4.73, I'll take it up to maybe 2% of the portfolio. And if it comes down to £4.06, I'd maybe even take it up to 4% of the portfolio. And if it went below that sort of £4 range, then I might be looking to take it up to the sort of cap of 5% portfolio. That is my strategy for this company. Watching it very carefully because in the next few days, the way the markets have been recently, this could hit that first price trigger point. Yeah, really happy with this company. Thanks to Luke for suggesting it. Luke, let's hear your comment below, please. What you think of the company you'd buy for your portfolio? Got a better stock than Autotrader to buy? Please share in the comments below. I'd love to see it. I might review that one next. Want to see what's in the rest of my portfolio? May get some ideas for your portfolio. Click on the screen now to see that.